Now, let's talk about how to build a low risk, high return portfolio. So, a strategy that focuses on minimizing risk while maximizing returns over the long term. So, the key here is diversification and smart capital allocation. Let me break it down for you. So, first, let's address the golden rule of investing, and that is diversification. Diversification means spreading your investments across multiple stocks, multiple sectors, and even multiple regions. So, why does this matter? It helps reduce the risk of one bad investment dragging down your entire portfolio. So, no matter how skilled you are as an investor, there's no such thing as a guaranteed win because even the best investors experience losses sometimes. So, the goal isn't to avoid losses completely, it's to win 90% of the time and minimize the losses from the 10% of investments that don't go as planned. So, diversification is your shield against volatility and downside risk. Now, when you build your portfolio, I recommend dividing your capital into a minimum of 10 to maybe 25 stocks maximum. Now, here's why. 10 stocks keeps your portfolio focused, but still diversified. Okay? But it does not dilute your portfolio too much. 25 stocks provides broader coverage, but it also avoids over diversification, which can dilute your returns. So, I personally divide across regions, across US, Europe, Asia, and I also diversify across sectors and stock categories like growth category, sometimes dividend paying, sometimes speculative, new startup stocks. So this way, my portfolio isn't overly reliant on one market, on one industry, or one type of stock. So there are various layers, okay? Now, but of course, as Muslims, we also need to add another layer, and that is to check whether the investment is halal or not. And we've spoken about that in a separate video. Now, let's talk about how to allocate your capital effectively. For core long-term investments, I divide my capital equally. So for example, if I have a $10,000 portfolio with 10 stocks, each stock gets approximately $1,000 or 10% of the portfolio allocation. If I have 25 stocks across $10,000 portfolio, then each stock will have about $400, right? So about 4% of the capital allocation. So for speculative investments, meaning stocks or companies that are fairly new, but they have very high potential for growth. But of course, this is done after doing all the research. For this kind of company, I will invest less than usual. So I take a more cautious approach. So I usually allocate about 1/3 or half. So if a typical allocation across 25 stocks is 4%, if there is a speculative new startup that I am investing in, I will only put in 2% instead of 4%. Okay, 2% would be the maximum. So this ensures that any high-risk investment don't have an outsized impact on my overall portfolio. Now, the question is, when do I add shares? If I've already bought them at good prices and the prices keep going up, when do I ever buy the shares, right? So, I don't just buy shares randomly. I follow a disciplined approach, and I'll only add shares of a stock if, number one, it is undervalued, right? So it is below the intrinsic value. And number two, if the price has retraced to a support level, that means it is at a good point to buy within the trend. And if it's bouncing off a moving average, for example, okay? So in this case, for example, we are looking at NVIDIA. If I've already purchased, but I don't have full allocation yet, in this case, when the price drops here, I will buy. Why? Because it is at a support level. You can see here price consolidating around here. It is at a support level, and it is also at the bouncing of the moving average, right? So this is a good place to buy, and it has retraced quite a fair bit. So absolutely undervalued, below its intrinsic value, and at the right timing. So this is where I will purchase, and I will allocate. If I already have 7.5% allocated, I will just buy another 2.5% here, and that's it. I'm done. I'm done for NVIDIA, okay? Now, yeah. So there will be times when my portfolio isn't perfectly balanced, right? Because you start off with 2%, 3%, 5%, and maximum 10%. But over time, that 10% may become 25% because the value of the shares have gone up a fair bit, right? And there will be other shares that you have that started off at 10% of your allocation. It has gone down maybe to 8%, 5%, you never know, right? So there is a rebalancing, constant rebalancing going on in your portfolio, right? So if the stock that I hold has already increased significantly in value, so meaning it takes a larger portion of my portfolio than I originally planned, when this happens, I'll reevaluate and I'll rebalance my portfolio as needed so as to maintain proper diversification, okay? Now, building a low risk, high return portfolio is all about discipline and balance. You should diversify across stocks, sectors, and regions to reduce risk. You need to allocate your capital wisely, so with equal weight for core investments and smaller allocations for speculative investments, okay? So stick to your rules when adding the shares. Only buy when the stock is undervalued, at a support level, and below your target allocation. Anything other than that, you don't add the shares. So by following these principles, you'll create a portfolio that's not only resilient to market volatility, but also positioned to deliver consistent returns over the long term. Now, remember, investing isn't about avoiding losses completely. It's also about building a portfolio that minimizes risk while giving you the best possible chance to grow your portfolio over the long term. And that's it for this video. I'll see you in another one.